Hello, best investors of YouTube. While the stock market and Nasdaq were crashing last week, my dividend portfolio was growing. And at this moment I have about 80k invested in dividend stocks with about 13,000 of net profit. Why dividend stocks during a crisis performs better than volatile stocks like Tesla, Palantir, NIO and others? Because all dividend stock companies I'm sharing with you every week are very stable. They have strong financial fundamentals and long history of payouts. Think about this for a second. Okay, which companies go ex-dividend this week? There are many of them, just let me show this table. You have a lot of beautiful companies like Nvidia, Home Depot, Coca-Cola, Merck, Gilead, Cigna and some others. But today I want to share with you some of the best companies I will be buying this week to improve my dividend stock portfolio. You can do the same. That's a great yummy companies like Coca-Cola, the Home Depot, UnitedHealth Group and Merck & Company. Okay, let's start with Coca-Cola. That's a dominant company in the beverage industry. By early 2021 it was selling 500 brands of beverages from Costa Coffee to Vitamin Maker and in 200 countries. And one interesting fact that in 1988 Warren Buffett bought more than 1 billion in Coca-Cola shares. It's a crazy amount of stock. At that moment that was equivalent to 6.2% of the company. And Buffett understood that no competitor was going to appear and take away Coca-Cola's market share. So I trust Warren Buffett. On the company, over the years, the company has steadily absorbed potential competitors and expanded into new trends. In their marketing, Coca-Cola's iconic name and global reach created a most around its core soft drink product. And their successful brand built the name recognition, the distributor network and the retail relationships that protect them from encroachment by competitors. So you have an exclusive opportunity this week to follow Warren Buffett footsteps and become a shareholder of Coca-Cola company and get your dividends soon, as the company go ex-dividends on the March 12th. Let me show some fundamentals of Coca-Cola. So first of all, they have a pretty high ranking, 3.2 from 5 based on Dividend.com researches. And they this week increased the amount of dividends they will be paying, and every year from every stock you will get a $1.64 with a payout ratio about 78%. What is really cool, consecutive years of dividend increases 59 years. And as I said, you can become a Coca-Cola shareholder before ex-dividend date March 12th. The next really strong company that I have in my portfolio is a Home Depot. The Home Depot stores that sell various building materials, home improvement products, lawn and garden products, they are everywhere in the United States. Home Depot operates more than 2,000 locations all over US, in Canada, in Mexico. And they are one of the biggest companies in the US that has a market capitalization about $300 billion. So the Atlanta-based home improvement retailer is often used as a proxy for US housing market. Meanwhile, this stock is one of the top stocks in the Dow Jones Industrial Average for 2021. And Home Depot's dividends has been growing for over 10 years. And overall, Home Depot's growth, profitability, dividend sustainability make Home Depot as one of the best choice even in a pandemic year 2020. So I made my first purchase of this stock in 2020 and at this moment I have about 1,000 profit just from this company. So let's look at the Home Depot's financial data. First of all, you can notice that they increased amount of dividends by 10%. That's a very sweet spot in their financial data. Also, you will have a $6 per share. That's a very high dividend yield. And their payout ratio about 52%. So what is really cool, they have a 5 from 5 on recommendation list from dividends.com. And you can see they were growing pretty significantly starting from 2005. So it's very stable, dividend aristocrat company. And the next really cool company, if you want to increase your exposure in a pharmaceutical market and medical market, is the UnitedHealth Group. UnitedHealth Group incorporated the world's largest healthcare company by revenue. And UnitedHealth Group generates revenue from a variety of sources, including premiums on risk-based products, fees from various services, sales on healthcare products and services, and investment. Primarily an insurer, UnitedHealth Group claims over 130 million customers worldwide. And the company has two divisions. UnitedHealthcare, it's a benefits arm, and Optum, a branch that encompasses three separate sectors: Optum Rx, a mail order pharmacy; Optum Health, which operates health savings accounts; and Optum Inside, a payment processor for healthcare providers. UnitedHealth Group has a market capitalization of nearly $330 billion, and it goes ex-dividend on March 12th. You still have some time to buy a share of the largest healthcare company in the world by revenue. Very sweet and cool company. Let me show some fundamentals of UnitedHealth Group. So, first of all, you will have a $4.83 of a dividend yield every year. They pay their dividends on a quarterly basis. They have 11 years of consecutive dividend increase, and they have a very high ranking, 4.6 from 5. That's a pretty high, and you can buy the share till the March 12th. So that's a financial fundamentals you have to know before buying this stock. And by the way, in case you want an alternative to this company, Merck & Company is another global healthcare company which also goes ex-dividend this week. This company offers health solutions through its prescription medicines, vaccines, biological therapies, and animal health products. It operates through 4 segments: pharmaceutical, animal health, healthcare services, and alliances. What about the latest news about this company? The White House said that the federal government is planning to spend about $100 million to help the recently announced vaccine partnership between Merck and rival Johnson & Johnson. It's a good sign for this company, so I expect they can increase their dividends in a maybe next quarter. And one more piece of information that you may find interesting as a dividend investor: which dividend stock companies may be big winners under Biden's tax policy. Okay, so let me explain why it's important. Under new Biden's tax rules, many dividend companies could get a boost or decrease in their dividend payout ratio. So you may ask, what companies will get more advantage under new tax rules? And for many investors, income seekers, real estate investment trust REITs have long been priced for the high yields. Due to their tax structure, REITs pay no corporate tax on real estate related business dealings. Because of the fact they are requiring to push more of their cash flows back to investors as a dividends. As a result, the sector offers above market average yields. However, since the Republican tax plan was enacted in 2017, some of REITs' appeal for dividend investors has been dented. And when you add in the effects of the pandemic on various real estate sectors and dividend companies, it's easy to see why REITs haven't exactly been a top draw last couple of years. But that could be a change in coming. And in that, REITs and some dividend stocks could be the sector de jour for investors looking for income and dividends. Biden is looking to raise the corporate rate from the current 21% to 28%. He's also floated the idea of adding 15% to minimum tax, prevent larger firms from being able to avoid taxes through accounting tricks and carry forwards. However, because of their structure, REITs and some dividend stocks avoid this corporate tax increase. For example, Bank of America Global Research estimates that this tax increase will directly affect earnings for many dividend stock companies. For example, analysts expect tech stocks to see a 9.2% decrease in profits, while healthcare stocks would realize about 8% decline. However, some REITs and some dividend stocks would only feel a slightly decrease to profits, less than 1% from Biden's plan. Simply put, investors will find that REITs and dividend stocks and their high yields are more attractive when corporations cannot promise the same level of dividend increase under higher tax restraints. For income seekers, REITs could be the play in the next year or in this year. So these effects of the pandemic are already starting to wane with the new vaccines and in work-from-home orders and rising consumer sales. This is all good news for real estate and for dividend investors. I hope you like this video. If you're a dividend investor, please smash the like button. Please tell me what companies you want for me to cover and what companies you bought this week as a dividend investor. Thank you for watching and peace out.